Hello, everyone. Dave Landry here. Welcome back to Trading Simplified. Wow, it's our eighth episode. It's really going quick. So, what do we talk about? Well, I've introduced you to the methodology and I showed you some setups, and we talked about money management. We talked about psychology. This week, I want to talk about market timing, and I want to keep that really simple, like everything we've done so far. I want to talk about some simple systems to help you time the market and a little bit about empirical research. And empirical research is something I could spend hours on, and that'll make a little bit more sense. I want to talk about the mystery charts as time reveals this week. And one reason I'm doing this is I want proof, or I want to prove that these trading simplified techniques can really work. And this is using real money with these. And we'll get more and more into that as time allows. So, where to find me? You can find me at davelandry.com. If you want more information, including the slides from this show, because this week I have a lot of information to go through, and I know it's going to be hard to comprehend it all in just one pass. So if you go to StockCharts, davelandry.com, I'm sorry, /StockCharts, and put your information in, I'll give you the slides from this presentation and all the other presentations prior. Also, this week we're talking about market timing. I have 20 something minutes to cover that, which is not nearly enough time, especially with the mystery charts and everything else. So there's a free market timing course within that sign up. And then if you have to reach me directly, or if any of this is really confusing, davelandry.com/contact. Okay, let's talk about market timing. Now, the way I look at market timing, to me at least, is less about beating the market and more about not letting the market beat you. So, what do I mean by that? Well, occasionally in the market will lose 50% and sometimes even more of its value. Now, I'll put the word occasionally in here. It's like, well, Dave, that doesn't happen that often. Well, I've seen two bear markets of 50% or more in my short career. So it does happen. And it happens a lot more than the statistics and the buy and hold people, or as I like to call them, the buy and hope people would lead you to believe. And the bottom line is when you see a market that's in trouble, the old hedge fund adage comes to mind. He who fights and runs away lives to fight another day. Now, I would focus on the downside magnitude of what occurs after a signal versus the mechanical signals in and of themselves. And I was thinking a good explanation of this would be something that everyone knows or likely knows, the death cross, which is the 50 going below the 200-day moving average. The media gets all excited about the death cross, and then they also get pretty excited about the golden cross. Well, the theory is you sell in a death cross and then you buy on the golden cross. And if we take a look at the last signal there, you would have ended up with an 8% loss doing that. Now, I have a good friend named Rob Hanner. He does a lot of testing, and I asked him a while back. This was a few years ago, so the numbers may have changed slightly. But he said there's a tiny edge, a very slight edge, nothing that you want to rush out and trade with something like the death cross, but it is about a 4% edge if you sold on the crossing to the downside and you bought on the crossing to the upside. More importantly, and with the systems that I'm going to show you that I personally use, it's the diaper change that happens after the signal. Now, borrowing that term from Ian McActivey, who was a good friend of mine. He was in the American Association of Professional Technical Analysis analyst, but he's no longer with us, unfortunately. But he did really great presentations, and he inspires me to put together good presentations every week. I try to channel him as much as I can. Anyway, diaper change I thought was a funny term that he used, but it's when a market sells off really hard and scares the heck out of you. So even though you would have lost money if you'd have taken this trade mechanically, you would have avoided 11% sell off just by exiting the market when you had the sell signal. Now, if we go back to 2007, 2008, we had a death cross way back then. And then several months later, almost a year later, we had a golden cross back up. But what's interesting is the market lost 54% of its value from that signal. And if you were going signal to signal, it still lost 38% of its value. So I think some market timing is better than none, especially when it comes to avoiding these diaper change moments. Now, take a look at 2000. We had a death cross back then. And then we had the golden cross. And this one actually worked out a little bit better because you have a lot of lag with the moving average system. And the market took 2 years to bottom out. So that worked out pretty good, even mechanically. But notice that the market dropped about 44%. And then even signal to signal, it's a 36%, drop. So that's pretty significant too. Now, if we go back to the 30s and we look at my 10% system, TFM 10% system, which I'm going to give you the rules to in just a few minutes. And again, if you need the slides, which has the rules in it, put your information in the link, and I'll give you that link again at the end of the show. Anyway, notice we had a sell signal, and then the market, believe it or not, lost 82% of its value from that sell signal. Now, you might be thinking, that was then, this is down, this is now. Well, that was the Great Depression. I'll give you that. But if we take a look at the same system and look at the NASDAQ going back to 2000, what's interesting here is the NASDAQ lost 66% of its value after the sell signal. And what's also interesting is peak to trough, it lost 77% of its value. So I think the point here is that bad things can still happen even in today's day and age. Now, one thing I like to use to help me stay on the right side of the market, or at least know if we're in a bull market or a bear market or a possible bull or bear trend is beginning, is to look at the weekly bow ties. Now, I'll also look at daily. In some cases, I'll even look at an hourly bow tie. But the weekly does a really good job of keeping you on the right side of the market. By the way, when it comes to market timing, I think you can end up chasing your tail if you're looking at too short of a trend. Years ago, I did a lot of mechanical testing. And in almost all commodities, I could make my systems work, but I couldn't get them to work on the S&P futures. And I later realized because the reason that they didn't work was because that they don't really trend that well. Now, the indices trend really well longer term, but over the short or intermediate term, not so much. So that's why I use weekly bow ties, which we covered a few weeks back in these shows. So if you're watching this on YouTube, when you get done, go ahead and take a look at those prior shows. I think this was probably the third show we did. And notice that we had some pretty serious sell signals before the bear markets. We did have the one whipsaw in 2015. And, the market did drop about a little, I forget what percent it dropped. I think the Russell 2000 dropped 18% from that signal. So it was nothing to sneeze at. And if you just blindly held through this, I think that's a bad idea. And then we did have another signal not that long ago, or I say not that long ago, seems like not that long ago, but that one didn't trigger. Anyway, as you can see, we have major bull and bear cycles, and they all start with a weekly bow tie. Now, let's talk about making market timing simplified. When I showed how great the weekly moving averages work, my bow tie pattern specifically for timing the market longer term, I noticed that just a 50-week moving average would also work out pretty well. I'm always talking about people and their systems and how we can make them so much more simpler. Well, that's sort of a dose of my own medicine when I looked at my 3 moving averages. What if I just took 1 moving average? Although I still like the bow ties, I also like this little simple system that I've created. Now, before we get into it, let me explain the genesis of this system. Can market timing be as easy as A, B, C? Well, what I'm referring to, the ABCs of technical analysis, is if a market is going to go from A to C and B is somewhere in between, it's going to have to pass through B along the way. So let's say a market's at $10. and then it's going to $30. Well, 20, obviously, B is in between. So the other thing I was thinking is, what would it take for a market to get to beyond C, not to be confused with Beyonce? Well, it would have to near C first. And then I got to thinking, well, what would happen, or how would we know if a market is in trouble? Well, I think if it dropped below near C, then it could possibly be going to B and possibly even go back to A, make a complete round trip. So I got to thinking, what would happen if we just stay long as we are near C? As long as the market is near its closing highs, let's stay long. And then let's look to exit if it moves too far away from C, or the closing highs, I should say. Now, for the S&P 500, let's let C equal the 50-week closing high. And then let's let 10% equal near C. So as long as we're within 10% of a 50-week closing high, let's say the market's in pretty good shape. If we're further than 10% away, then the market could be in trouble. Now, we'll come back to that in just one second. So the other thing I got to thinking about is, what would happen if you would just stay long or short a market as long as there is Landry Light? I'll see presentations that people do, and not to take anything away from them, because I'm sure they worked hard on it. I'm sure they have some great research, but they'll have dozens of buy and sell signals on a chart. And usually there's always a moving average just by default that's plotted. And I'm often in these presentations and think to myself, looks like you could have just bought when the price, specifically the lows, are greater than the moving average, and then sell when the price, specifically the highs, or less than the moving average. In other words, there's Landry Light. So I'm a firm believer that stay in the light is good. I'm laughing because I have so many anecdotes that go along with that, but not enough time today. So Landry Light simply means that the lows are greater than the moving average. Now, this is a real chart. If memory serves, I think it's the S&P 500. I just did a screen capture and noticed that for a long, long time, the lows were greater than the moving average. And we'll look at some real charts in just one second. Now, on the downside, the highs are less than the moving average. In other words, you can see a gap, so to speak, or a light between the highs of the price and the moving average. And notice that you can have some really great trends with this simple little indicator alone. Go back and watch, I think it was episode 1, where we talked about how to determine if a market was trending and use simple things just such as Landry Light. Now, if we take a look at a long-term weekly S&P 500, and again, downside Landry Light means that the highs are less than the moving average. And notice that in the bear market back in 2000, 2001, we had a lot of downside Landry Light. And then the market turned around and noticed that we had upside Landry Light, meaning that the lows are greater than the moving average. And that was almost for that entire uptrend for years as the market worked its way higher. It had a few little kisses of the moving average, but no downside Landry Light to speak of. Now, take a look at the bear market in 2008. Notice that we had downside Landry Light the whole time. And then, of course, on the bull market that followed, we had mostly green, in other words, upside Landry Light for that entire trend up. So it's amazing to me that you could take something as simple as Landry Light, and that'll help to keep you on the right side of the market. Notice that, again, mostly green during the bull phases, and very little red, and mostly red or entirely red during the bear phases. Okay, when we come back, we'll take a quick little break here, but when we come back, we're going to talk about the rules for the system and tie it all together. left off, I was talking about using Landry Light to determine trends and also combining that with a market that is near C. So I got to thinking what would happen if I took the two of these things and made a simple little system. And to my amazement, it works really well. And there's one thing it accomplishes, not that it really beats buy and hold in an unbelievable way, knocks the cover off the ball, but more importantly, it avoids those big drawdowns. In other words, those diaper change moments. And I'm going to flesh that out in just 1 second. So the rules are very simple. And again, if you just put your information in, you'll get the slides with all these rules in this. And you'll also get a market timing course, which has a lot more information on this. So we're just kind of going to skim over it today. But don't worry, there's plenty more information, and I'm not going anywhere. You want to buy the market when it is 10% or less away from its 50-week closing high, or I should say less than 10% away from its 50-week closing high. In other words, it's near C, and the last 2-week lows are greater than the 50-week moving average. In other words, you have 2 weeks of Landry Light. Now, on the downside, since prices tend to drop quicker than they rise, they take the escalator up, and they tend to take the elevator down. We're going to exit when the market is 10% or more away from its 50-week closing high. In other words, it's no longer near C, and the close is below the 50-week moving average. We're not going to wait for the downside Landry Light, because by the time you get the Landry Light to the downside, it could be too late. So let's take a look at what that looks like. Here's the last signal that we had, the last sell signal. Notice that the market dropped over 10% from its 50-week closing high. By the way, for those of you who are wondering and asking me about indicators, I talked with Grayson over at StockCharts, and he is going to be working with me on adding some of my indicators. I really don't have that many indicators, but there are some things such as measuring the percentage away from the closing high and things like that, Landry Light, that can be useful. So keep an eye out for those. Just give them a little time. They're really busy over there, so I'm waiting for them to get back on that. But anyway, long story unless we could see that the market dropped 10% from its 50-week closing high, and then was also I should say, closed below the 50-week moving average. And that's the entire system right there. And it'll make a little bit more sense as you walk through some of your own examples, or research on your own, I should say. But notice that it did drop 11% from that signal. So let's take a look at the results. And again, we're going to focus on avoiding the diaper change moments. In other words, we want to be out of the market when something really bad happens, and we want to continue to follow along as long as the market's in pretty good shape. So again, if you look at these bear markets in here, notice that it got you out before the market dropped another 44% or 52%. So basically, before the market essentially halved in value, a simple little system like this got you out. Now, the last signal here, the sell signal that we had back in November of 2018, the market lost 11% afterwards. And that's nothing to sneeze at. And the thing about buy and hold is it really teaches you to be a bad trader, a bad investor, so to speak. I recently moved, and back in January, I moved to a rental house, and then I moved to my new office, which I'm in now, new house too. And when I rented the U-Haul, the guy in the place had on CNBC, and I said, well, I know a little bit about markets, and he really didn't seem to care. But anyway, he said that he was glad he held on through December, and he wished he would have bought more. Well, trust me, sometimes the market goes down 10 or 11% and then goes down another 30, 40 or more percent, as we saw recently. Now, I don't sit around and wait until I have a weekly signal. But as I said earlier, because trends don't come along every day, or I should say the market doesn't trend very well over the short to intermediate term, I think you have to take a longer term approach to your market timing. But I pay attention to what's happening shorter term. And by that, I mean I listen to my database. Now, this is a whole presentation in and of itself. So let me just go through it as quickly as possible. I look at a couple thousand charts every day looking for setups. And I went back to the peak. And this is a presentation I did a few weeks back, or a few months back, I should say. But I noticed the peak back in September, and I wanted to look at my list of stocks that I was looking at. Even though the market was at new highs, my list of stocks was mostly shorts. Now, these are all pullbacks, bow ties, and other patterns such as TKOs that we've been talking about all along. And you'll notice that some of them have made their way into the current portfolio, or I should say are still in the current portfolio from way back then. But what's interesting is on the long side, the ones that are in green are potential buy signals. Those were golds and energies and REITs and a lot of areas that could trade contra to the overall market, or certainly can go up even though the market goes down. Now, on the short side in the red, notice that nearly everything in here, with the exception of, I think, one retail stock, but for the most part, everything was technology related. Now, technology in general is momentum and growth stocks. And what I've learned over the years is growth stocks get hit hardest and the fastest. So going back to my list back at the market peak in September, notice that we had mostly shorts setting up, and alongside was stocks that could trade contra to the overall market. And we did go ahead and put on some shorts, and those have really done quite well so far, in spite of the market going right back up. Now, here's some quick thoughts on market timing. And again, we're just scratching the surface here, but every bull or bear market will have a signal, but not every signal will lead to a bull or bear market. So you have to treat every signal as it will become the big one. And that's something that Greg Morris talks about too. Back when he was running $5 billion, they would treat every signal as if they were getting ready to enter into a big bear market. And I've done many columns where I've said the same thing. You know, it's Elizabeth implied. I don't know how many of you are old enough to remember that, but Stanford and Son. My favorite all-time saying, which I say often, is he who fights and runs away lives to fight another day. You need to be, again, longer-term oriented in your market timing, but shorter-term oriented in your trading. So when you do see some shorts setting up, even if the market is at or near new highs, you need to begin to pay attention. So I like to listen to the database for a heads up. And you might want to go ahead and nibble at some shorts when you have a plethora of shorts showing up and the market is losing steam. So we weren't necessarily breaking out to new highs back in September, but we were seeing quite a few shorts setting up. And as I alluded to a little while ago, momentum will get hit first and hard. I used to maintain a list. I wasn't actually trading this list, but it was for an institutional project, or potential institutional project, I should say, where I had 100 momentum stocks. And this list would absolutely print money until it didn't. Every now and then it would get hit really hard. And usually after it got hit hard, even if the market was making new highs, 2 or 3 days later, the market would sell off hard. Now, if you are on the long side, you have a lot of longs in your portfolio, just allow yourself to stop out. A lot of times the ebb and flow will control your portfolio and put you on the right side of the market. All this longer term market timing is great, but you want to make sure you listen to the database first, and also through money management, be willing to get out of positions when they begin to go against you, provided, of course, they hit your stop. Now, I want to talk a little bit about some mystery charts and get through as many as we can. And the reason I like these so much, and by accident it became a feature of the show, but I love them because it gives me a chance to show the methodology in action. A lot of these charts, in fact, when I first show them as mystery chart, they're just in the early phases of setting up, and sometimes they haven't even triggered yet. So let's take a look at CMRE. And if you go back and look at the archives, you'll see all these in real time. Notice that we had an entry at $8. We had an initial profit target of $9.58. And this stop has been raised a little bit since it's moved in our favor. And so far, let's take a look at the chart of what's happened. There's a TKO. If you go back a few shows ago, you see we talked about the TKO. Here's our buy. You can see that it triggered, and our stop is down here. And the initial profit target so far hasn't been hit, but that's okay. I'd like to show these things ahead of time just so that you don't think, well, this guy's just showing me a bunch of stuff in hindsight. Now, PLMR, this was another one of our mystery charts. And you can see that our entry was 44.80. The initial profit target was 52.90 and a stop of 37.70. So this, again, was a TKO, a pattern we talked about a few weeks ago. Again, our stop was there. Our entry was up here. And so far, it's worked out fairly nicely. Now, again, I like to keep things simple. Here is the cocktail napkin that I created a couple of months ago before speaking engagement in San Francisco. And this is pretty much the entire methodology in a nutshell. We're looking to buy pullbacks for the most part. And only if and when they trigger an entry, we're going to put in a stop because we could be wrong. Nobody knows exactly what a market will do, not you, not me, and certainly not the guy who screams on TV. As I often say, we're going to take partial profits just in case we're partially right, and that's 1/2. And we're going to trail a stop higher in order to stay with that trend longer term. If you take a look at the money management presentation I did a few weeks back, I'll allow it to make a lot more sense. So here's our mystery chart reveal this week. It's T and K. This was the original buy back in November. An entry of 210, a stop of 160. The pattern was a pullback. We were going to risk a 1/2 point. And based on a $100,000 account, for every $100,000, you would trade 2,000 shares. So that gives us 4,000 shares. And if we add that to the entry, to the risk, that's going to give us our initial profit target of 260. So let's take a look at that. So here's the chart. It was a pullback. We had an entry up here, a stop down here, and initial profit target up here. Now notice that we came really close. We came within 1 cent of the initial profit target. Now it's rallying a little bit today, so that's a good thing. But one thing I'd point out is you don't want to split hairs. It's very hard to make everything work on a mechanical basis, but you have a brain in your head. You're within 1 cent of a profit target. You've been in a trade just a few days. Go ahead and think about exiting some shares when that happens. And then once you do, we're going to trail that stop higher and get the stop up to break even. Okay, Rachel, do we have any questions?
We do. I'm going to have to forward those to you because we're running short on time.
Okay. All right. So briefly, we're going to talk. One thing I was thinking about as I was going live this morning is the secret to trading is waiting. And if you look at my trading service over the last several days, you'll notice that I haven't recommended anything in a couple of weeks, and we're just continuing to manage the positions that we're in. So waiting is key. Again, if you need to reach me, here's the information. And once again, I want to thank everybody for watching.